The gold markets appear to be putting on the Bob Dylan hedge sooner than I expected and taking shelter from the Phase 2 storm. Gold is trading in a $1,547 to $1,553 range so far and bids on. Unless we get a more on-the-nose type of surprise, like an explicit roadmap for a further rollback in tariffs, strategic buying on dip should remain in place. The current level of P1 tariff rollback is unlikely to provide enough U.S. domestic economic punch to shift the Fed hawkish. But the one buyer beware for gold bulls would be in the event central banks in general turn less dovish amid risk-on sentiment. Until that unlikely pivot, gold should head higher over time. Given the differences between the US and China are so vast, it's likely worth hedging the tale that the P2 deal might not ever happen. After all, China seems to be adjusting well to life without the US demand impulse. However, with trade becoming little more than a political mechanism in an election year, oh yay, another reason to own gold, who knows what's going to happen on the trade war front. But it's this inherent uncertainty that makes gold an excellent go-to hedge. As for macro, while the economic data is suggesting things haven't got worse, still, at the same time, it doesn't point to a significant re-rating of the economy. Friday's NFP print the latest example of any bullish risk momentum getting snuffed out. So far this year, the tremendous global growth trade of 2020 has been a bust, and you don't need to look much further for evidence than the resilient USD and sagging oil prices. Gold's Tuesday's candle indicates seller exhaustion, but lower highs setup still intact. Short-term average studies have turned bearish and prices risk falling back to $1,540. Gold is currently trading at $1,548 per ounce, having clocked a low of $1,536 on Tuesday. The long wick attached to Tuesday's candle indicates seller exhaustion, meaning the corrective pullback from the 6-year high of $1,611 reached on January 8 has likely ended. Even so, it is too early to call a bull reversal, as the lower highs pattern is still intact on the 4-hour chart. A move above $1,563 is needed to invalidate the lower highs setup and confirm a bullish revival. A move above $1,563 may not happen on Wednesday, as the 5- and 10-day averages have produced a bearish crossover and the 5-day average hurdle is proving a tough nut to crack in Asia. So, despite the bullish divergence of the 4-hour chart MACD, the metal appears on track to retest $1,540. That said, prices could challenge the 10-day average hurdle at $1,543 before a potential slide to $1,540. Please subscribe our YouTube channel. Listen News here. If you like the video, please like, comment and share the video.